I don't think I've ever had a Guinness. Unlike Scott Wu,
Amazing.
I've had many, many, many beers, perhaps thousands, but I'm not sure I've ever had a Guinness. Without an alarm clock, I will wake up almost exactly between 2:55 and 3 a.m. almost every day.
Wow. So you wake up ahead of earnings.
No, forget earnings. Every day.
I just want to see what happens at the open.
No, I don't want to wake up. I actually don't want to wake up. I mean, if I ran a private company like Stripe, I wouldn't go public. I think the public markets,
It's kind of ironic because you're a public markets investor.
Yeah, I think the public markets are kind of problematic at this point.
Should we try to split the G?
Oh my God. No, we covered this in an episode with an actual Irishman. It's an invasive species. It's a made up TikTok.
Yeah, how did that start?
You can. You're a cross American, so you can, and maybe we should get it on camera, and that would be funny.
Were we trying to do this? Split the G?
Only Mike is.
Only Mike is, unless you. Oh, that's so good. Not close.
Oh,
That's not bad.
that's not bad.
Can we zoom in here, please? Camera roll 3.
Dan Sundheim is one of the world's top hedge fund managers. He runs D1 Capital, which invests in public and private companies across a bunch of totally different industries. Dan's one of the smartest investors I know, so Daniel Gross and I tried to get into his head and figure out how he analyzes companies.
Cheers.
Okay, Daniel and I were wondering, what trading app do you actually use? Like, if you are trading underneath the table during the interview, like, are you in Interactive Brokers? Are you WhatsApping someone who executes it?
I'm just emailing. I'm emailing the trader with that. Yeah. I mean, I'm checking Bloomberg all day long.
Yeah,
That's the app on my phone.
Yes.
But I'm just emailing, texting my traders.
And if the trader's like sleeping or something, is there an app that you use? Or is
If he's sleeping during the day, we haven't encountered that problem. That'd be a different problem.
Another performance issue,
but if
yeah.
he's sleeping at night, we actually have overnight traders in Asia.
once you told me when you struggle to sleep at night, there's nothing better to do than wake up and start trading Asia. So is that your East Coast trader, or do you have another person?
Yeah, we have another person who sits in. That we outsource.
I see.
Yeah.
I see.
Yeah.
And then what fraction of AUM is just Dan Sundheim trades? Or Dan Sundheim decisions?
95% plus.
Oh, so all of it.
Yeah.
Okay.
Yeah. I mean, people have trading authority.
Yeah.
But most of the trades, I put it myself.
Okay, so memos come up to you, and then you ultimately size them and decide whether to do them or not, or something like that.
Yeah, I mean, the process starts way before the memo.
Yeah.
Like I'm in dialogue with the team about the idea, why they like it. We're having conversations way before it gets to the memo stage. By the time it gets to the memo stage, I mean, usually we start buying it before, because in the public markets, if you have a good idea, you could take a month and a half to write a memo, but by that time the price may have moved. So usually we start buying it before the memo is done, and then the memo is kind of the final, compilation of the due diligence, and that's when the best thing that could happen is we're buying it, and then the stock keeps going down. So by the time you have the memo and have even the most conviction,
right,
you can buy more. A lot of times it's going the wrong way.
But what fraction of the time, do you finish writing the memo and you're like, oh no, this is a terrible company. This is not good.
Yeah. No, that doesn't happen, because usually they'll start writing the memo and then they'll come to me and be like, I think I made a mistake, and we'll sell it. Rarely have I don't think I've ever owned a position because we had discussed it, then read the memo and been like, oh my God, what are we doing here?
Yes.
That'd be a bad sign for the analysts.
We jumped right off the deep end. Describe what D1 does, AUM, strategy for the uninitiated.
Yeah, so we invest in public and private companies. We do fundamental analysis, and so deep research, trying to understand business models, trying to understand company prospects, choosing the right management team, and whether it's public or private, we're investing with a horizon of 3 to 5 years. And we applied the same due diligence process to both public and private. Obviously, private is a one-way door, and public is a two-way door. So, that's different.
Is private actually a one-way door, even as just the private markets have matured and there's so much more secondary activity and things like that? Do you still have to treat it as a one-way door?
Definitely. I mean, you can sell, the best companies you can sell easily, but those aren't the companies you want to sell. So, we rarely transact in the secondary market because, we don't want to sell the best companies. And it's hard. People think you can just transact in the secondary market, but if you're going to sell $50 million, $100 million, people have to get information rights from the company, and then it's like.
And it's viewed as a signal if you're like large.
Exactly. If I go to the management team and say, I want to sell, and the person doesn't follow through, it's not great.
Yeah.
So the AUM is about 25 billion, about 2/3 private, $10 million public. Public is long, short, all bottom up, no quant. Really kind of the same thing people were doing in terms of stock picking 30 years ago.
And when you say no quant, that is, you're contrasting to some of the more short-term kind of technical firms that are just trading based on what will happen the next day, the next week, the next month.
Exactly. And we're not using any computer programs to guide our trading. We're not, we are not trading based on quarters. Yeah. We're, you could be doing my job the same way 20 years ago. You wouldn't have exactly the same tools, but it's just,
Do you think of any of those signals that people talk about when you think of when to enter or exit a trade, like the stock would be oversold or overbought?
No.
Okay.
No. What I find interesting about you guys is you're long-term in that you're not like you're saying some of the quant guys who are just trying to predict what happens, in the next, what's the next buyer doing, or the high-frequency guys or something like that. You're instead just thinking, like, is this company selling good product? Will their sales exceed, what people expect? And will that add up to a good business? And so, like, the work is evaluating future earnings of the company. But there are some people who are really buy and hold. Like Costco seems to attract a lot of shareholders who think there is no price that is too expensive for Costco. And there's kind of a huge loyalty there. Whereas you kind of have a price on both ends where, at this price, I'm an enthusiastic buyer. And at this price, God bless him, I'm selling the entire position. And you kind of have that price boundary at both ends.
Yeah. Practically, we may say, we think that in 3 years, this company is going to be worth double, right? So kind of roughly 20-something% IRR. But if we're right about the company, usually it doesn't go 24%, 24%, 24%. People pull forward the IRR. The stock may go up 50% in the first year if things go well. Then the forward IRR all of a sudden looks a lot, worse, and you're kind of moving capital to the next opportunity. I think the biggest mistakes, if we would look back, it's easy to think about the mistakes where you lost money, and you think about those a lot, but the biggest mistakes are selling the Costco's too early because, the IRR is totally dependent upon what you assume the exit multiple is, and that is difficult to be precise about, what the right exit multiple is for a business.
So let's talk about painful mistakes. Like, can we talk about Netflix or something like that?
Yeah, so Netflix, when we started the firm, almost every LP I met with, they always want to hear a stock pitch. So I pitched them Netflix. And actually, when we were interviewing candidates, what we did was we gave every single interviewee the same case study. We said, this is in 2018. Mm-hmm. So we said, look at Netflix, look at Spotify. If you had to buy one of these businesses and hold them for 5 years, which one would it be and why? So it was like Netflix all the time because I was talking about Netflix with LPs. I was talking about it with interview candidates, and ultimately the thesis was correct, and I didn't hold it long enough.
And so in 2018, the reason Netflix was contrarian was it was obviously a great product that people loved, but they were burning a lot of money, and so it was just not clear, was this like a classic tech company where would they ever make money? Like that's why it might have been contrarian with LPs.
Yeah, I think the issue is there's very few tech companies that are massively capital intensive, right? Almost every tech company loses money for a period of time. But the typical software company, you're looking at there's operating losses, you leverage it, and then people are very used to that business model. Up until the LLMs, there are very few tech companies where it's like a huge fixed investment, and then the incremental margins on the sales are extremely high. And so what that meant was that Netflix was investing heavily in content, which is a fixed cost, and then they were selling that to consumers. The next year, they were investing more in content and selling it to more consumers. But you're constantly investing more and more in content.
And the skeptics thought this would have to keep going up forever and they'd never make money.
Yeah, because the cash flow just looks worse and worse every year because you're investing more and more. But ultimately, that created a moat that was, I think, the defining, aspect of the business model that made Netflix what it is today. Meaning that it's like a flywheel. Right. You invest a ton before anyone else. Actually, what happened here is the media companies enabled Netflix by selling them content. And then Netflix invested a ton, sold to people globally, took that money, invested more in content, actually borrowed in the high yield market, invested more in content, sold it to more people, and then the flywheel, then, within 5 years, they're investing way more in content than anyone else. They're selling it to way more consumers. The incremental cost of selling that content is very, very low. And so you have this fixed asset that you've built up that it's.
And what kind of ultimately caused you to sell it?
We had transitions on our team, and look, we cover every sector, right?
Yeah.
So there's we're covering at any given time 300 stocks, and we had transitions on our team, and our media analyst left, and I was focused on other things. It was not excusable because if I look back, we get plenty of things wrong, but Netflix.
Yeah, how
we
do you
got
think
exactly
about,
right.
there's like a sense of, do you ever have this issue where like people want to pitch in new things because they're like new and exciting, and I guess like the good old Occam's razor idea is just hold what you have? And do you ever have to push back against that?
Yeah, I probably should push back more.
Yeah.
I mean, I think it's like a human tendency, like, oh, this is a new company. I love investing. Let's learn about this new company, and this sounds super exciting. But at the end of the day, there's like only so many amazing companies.
Yeah.
And trying to, sell them and move into something else is almost always a bad decision. That's the nice thing about the private markets is that once you invest, you can't sell. And usually for the best companies, that's a huge benefit ultimately.
Yeah. I just want to go back to the starting D1 for a second. So the lore is that prior to D1, you were at a firm called Viking. Is that right?
Yep.
And the lore is that almost all of Viking returns increasingly came from Dan Sundheim offhandedly making a comment to someone at the water cooler that, oh, that could be a good stock, or definitely don't invest in that. And people would be like taking those trades as their own for the most part.
Those are your words, not mine.
Yeah, that's the lore.
I never said that.
That's the lore. And I guess my question is, when someone comes up to you, an analyst on your team today, and says, oh, hey, what do you think of XYZ? And you do that sort of Dan Sundheim 30-second, 10-second take, what is going through your head exactly that gives you just this binary sense of like, looks good, not good?
Well, look, I mean, every situation is different. I think the biggest risk is sometimes people will come to me with an idea, and like they come to the idea and they pitch it for a little bit, and I think about it, and I give them an answer, and I don't have enough information to give them a really solid answer. But whatever I say, they think is like, okay, well, if he said that's not good, then I'm just going to forget about it, and that's actually not. That's not constructive. Like, I am wrong all the time, even when I've done a ton of work. And if it's just like a 30-second pitch to water cooler, I can say like, that sounds interesting, or I can say that doesn't sound interesting.
Yeah.
But I'd say my hit rate there is dramatically lower than once we've done all the work. And there is a risk, like analysts are like, they try to take my temperature, and if it's going to be something that interests me, and if it's not something that interests me, don't waste time on it. That's actually not great.
But I think what Daniel is getting at is like, you seem to have an intuitive sense for companies, and in this underwriting, like it's not just all about does the model, spit out a 19% or a 21% IRR, and what is that the spidey sense is picking up on?
I mean, I think it's like anything else in life. It's like pattern recognition, right? It's like part of it is just understanding business models, understanding, what kind of valuations companies should be trading at. Part of it is just having invested in this capacity for 20-something years, you get a sense. Like if somebody comes to you and pitches like an idea to allocate a ton of R&D resources to some engineering project, you probably have a pretty good sense, like up front, whether or not like they should go write a big memo proposing that or not.
When you interview younger...
It's an art, not a science. Like,
Right. So when you interview younger, say, portfolio managers, or when you meet, do you have a sense fairly quickly if they have whatever this is? Like, do you think this is a thing just people have or they don't?
I think the answer is yes. So a couple things. One, we don't hire portfolio managers.
Right.
I pretty much only hire people who've never done public equity before, which has pros
So
and
what
cons.
have they done before?
Usually,
Piano teacher.
We typically hire from private equity, and because then they have the analytical skills, they understand accounting, they understand financial modeling, and then we can teach them the stock picking. Right? And if I hire somebody laterally who's a portfolio manager in another fund, that's rarely been successful, almost never. So
Because of some negative transfer, like they have expectations.
because
that are
everybody
wrong,
has a different,
Yeah.
like every firm has a different approach to investing, and getting people to change their habits to align more with how we invest is incredibly difficult. Now, like if I hire somebody from private equity, it takes about 3 years for them to really be like contributing to D1. So obviously it would be much faster for me to just hire an external, and there's funds who do
And
that
what is that? So
successfully.
like they come in, you say it takes 3 years. What's happening? You know, they're 3 months in and they're trying to speak up in a meeting, and you must be thinking to yourself, this isn't really the D1 way. Like, what is that exactly that changes in them over the course of the 3 years?
Yeah, I mean, look, I would tell you that I wish that it is incredibly difficult to figure out who is going to be great. And even after 3 years, I'd say our hit rate still is not as high as you would expect. Like, I imagine if you hire an engineer, after 3 years,
Yeah.
you probably have a pretty good sense that that guy's a good engineer,
Yeah.
or girl's a good engineer. I think that I have a pretty good sense, but it takes even 5 years. I mean, to really get a sense, because some people, start out where they're analytically really solid and they work incredibly hard, but like the actual intuition of like stock picking hasn't come to them yet.
So is it because you're saying like the job is so pattern recognition oriented that you just need some time to build up the pattern recognition, and like is that what they're learning?
Some people, like once in a while, people come in and like right out of the gate, you're like, wow, this person like sees it. They're they see the ball really clearly.
Yeah.
But that is a very small fraction of the time. Most people get great over time, and they have to learn an industry. So when they come in, we will say, you're going to cover fintech. And it just takes them a year just to understand fintech, right? Then they have to see, well, why is XYZ stock trading at this multiple? And why is this stock trading at this multiple? What's the market saying? And I think it's like the market is constantly giving you data points. Some of them are, false signals, and some of them are good signals. And over the long term, they're all good signals. And the people who do great at this job, you have to have like some commercial sense, which I think is like probably just you're either born with it or not.
Charlie Munger's money-making gene.
Yeah, I wish I could test for that. It's impossible. But you also have to love the job. Like you have to wake up in the morning in the shower, be thinking about like your stocks. You have to this isn't like the kind of job where you're like, you close your laptop, you go home, and like you forget about it. It's kind of always, you have to always be on. And there's people who love it. And if you love it and you have that commercial instinct, that's, and you have to be analytically sharp.
Do you have a leaderboard of individual people's like portfolios and how they're doing compared to each other?
Yes, everyone has like what we call a mock portfolio. So every week they have to take the positions they cover, and they have to say, if I was managing capital, here's how I would allocate capital among the names that and then what happens at the end of the year is that sometimes it's like, I own these 5 stocks. My mock portfolio was up, and we take it very seriously. Like the mock portfolio is actually goes into people's comp. Sometimes it's like that that person did phenomenally well in their ideas, and I didn't monetize them. And then sometimes it's the opposite.
Right.
But like it takes care of a lot of the typical hedge fund thing of like at the end of the year, like everyone like remembers the things that they want to do that worked out and forgets what so.
People have to pre-register what they're going to come to you at the end of the year and say, "See, I was right."
Yeah, exactly. So I know, like, did I?
Do you ever have a situation with the mock portfolio where someone goes short something you're long, or vice versa? That hasn't happened yet.
No, that hasn't happened yet. But like, there are big discrepancies between sometimes analysts will be like, I think this is a 5% position, and I'll be like, I think you're crazy. I think this should be double that.
Do you have a mock portfolio yourself, or is D1 your mock portfolio?
No, D1's my. that wouldn't be very useful. Yeah, D1 is my mock portfolio.
Yes, and then you talked about sizing positions. Everyone's coming to you with all these good ideas, because presumably they're not bringing you their bad ideas, and they're like totally idiosyncratic. Like some are super safe bets, some are like kind of flyers, some are industrials and tech and banks and everything. How do you size positions, and how do you just assemble that into a sensible portfolio?
Yeah, that is really difficult to answer because it is, it is like entirely an art that we're always trying to get better at, and we look at tons of data just to see what we could do better. But it is really just to feel like, look, for every stock there is a target price, but then there's also what kind of risk. There's a risk reward calculation.
Mm-hmm.
Like, okay, like maybe you could make 50%, but you also could lose 50% if you're wrong. Sometimes you can make 25%, but the risk of losing money is quite low over time. And, it's a matter of like, you have to compare those two ideas, which are, inherently very, very different, and construct a portfolio which has, you don't want all names where you could make 100% but lose 40, but you probably don't want to have a portfolio full of names where you're only going to make 20% and lose 3. So it's a lot of things that go into it. There's like the risk reward, there's like the ultimate upside. There's a sense of like what's currently happening in the business. Like, if a business we think currently has a lot of momentum, I'm not predicting quarters, but if the business currently has a lot of momentum, the chance of you losing money in the short term, assuming it's at a reasonable valuation, is much lower than if a business, we're often buying businesses when they're going through really tough periods, right? You have to be very careful because, often that's the best buying opportunity, but, that's the riskiest time too, because sometimes it's hard to call the bottom.
When you say you have to be really careful, isn't there a principal agent issue here where when you analyze a company, you try to see, you try to predict what its earnings will be 3 years hence and be more right than everyone else's. Maybe they're too pessimistic on the company and you think it'll actually really over-earn compared to people's expectations. But you're actually really sensitive to what people think in the short term because your LPs are grading you on the performance in the year and the performance in the quarter.
Correct.
And you're judging this poor analyst, and their job on the mock portfolio, which you're saying is like updated weekly. And so aren't you not actually looking at companies on a 3-year time horizon because they have to like perfectly perform at every step along the way and they can't be misunderstood for any short period?
Yeah, the way I think about it is any given time, we are planting seeds and then we're harvesting. Like there's some companies that we invested in a year ago and our thesis is starting to play out and you're making money hopefully on that idea. And, maybe you're selling that idea at that point and then you're putting in new ideas in the portfolio that might take another year to play out. And so it's not like if we started out with a bunch of ideas that all had 3-year targets all at once, like, yes, but like the portfolio is a living thing that like you have a range of positions, some you've had for a year or two and you think the business is going to turn, the stock's going to work, and then there's other companies that you're buying now because they're really depressed and really out of favor and they're not going to go up in you don't think they're going to go up in the next 3 or 6 months. But over any medium-term time frame, they will. So it's like always...
So you have limited capacity in your portfolio for the out-of-favor stuff, where like ultimately you're smoothing this for LPs, where you always need some companies that are performing and are popular.
No, because like, I may have bought a company a year ago that was out of favor. And maybe it's still out of favor, but eventually like, the way economic cycles or industry cycles work, the company I bought a year ago, maybe I didn't make money on it for the first 9 months, and now it's starting to inflect. And I'm putting a new company in the portfolio, which is out of favor, and that will start to work. It's impossible to predict. That'll start to work 6, 12, 18 months in the future. But if you have a portfolio of things that you've built over time, our monthly returns and quarterly returns are purely an output. Like there's nothing, it is arbitrary in some respects. I think, Jeff Bezos once said, like, when people congratulate him on a quarter, he said like, yeah, but that quarter was cemented like 3 years ago when I made this decision to do X, Y, Z. It's kind of the same thing with us. When the stock's working, we probably were investing in that stock a year, 18 months ago. And then, now we're investing in a new stock, which hopefully will pay off in 18 months.
So one thing you're kind of famous for is pain tolerance. You go through phases of euphoria in markets, you go through phases of pain in markets. And I was just wondering if you could walk us through maybe across D1's history, the most painful phase and just how was that for you?
It's a very oblique way of asking about GameStop.
I do have a high pain tolerance, but so the first 3 years of our fund did phenomenally well, way better than I would have expected. There's always some mean reversion. You expect that, like, okay, like, the next 12 months are going to be harder because you've just made so much money. As we were entering 2021, we had an amazing run. Everybody at my firm was like, elated, like they had, everyone had done well. They were part of a winning team. And, for me, I'm always like a little nervous in the back of my head when things are going too well. What I didn't expect was that the mean reversion would happen within 3 weeks and would, be so dramatic that like we never came close to going to business, never had margin calls, never. But it was an absolutely insane,
So what
harrowing
happened?
experience.
What 3 weeks was that?
Okay, so 2020 ends, everything's great. We're up. I don't even remember how much we were up, but
A lot.
very, very high. And back then we are fairly aggressive short sellers. Like I like shorting stocks. It's masochistic. I love doing it, and I've always liked shorting stocks. And this is at a time when we go back to like 2021, think in your head, the government was mailing everybody checks. Everybody was sitting at home. They weren't going to the office. Reddit was starting to become a big thing. And all those things came together to create a massive short squeeze on the order that I've never seen before. The way I've always thought about stocks is like, let's say I short a stock. I think it's going to earn X. I know that if I'm wrong, it's going to go up this much, and probably goes up more than it should fundamentally because people are short and they're going to have to cover. That's my whole career. I've never had in my risk reward framework, nothing happens fundamentally and a stock goes up 400% in 2 weeks. That's what happened. And if you think about what shorting is leverage, right? It's just borrowing shares that you have to pay back. Imagine borrowing a lot of money and the amount that you have to pay back goes up by 100% every week.
Yeah.
That's very stressful.
It's like the developing market debt trap, kind of.
That was quite stressful.
Yeah.
And then imagine that also at the same time, the American populace is basically all like coming together to think that like these are the people you should attack, these short sellers. So it was like CNBC was like, it felt like everybody was behind this massive short squeeze and felt like it was a great thing because these hedge fund managers were paying, for what?
That was the surprising thing, right? Because it's the age-old, in a crisis, all the correlations go to one, and things that are supposedly in your model uncorrelated actually turn out not to be. This is the long-term capital management issue. It's like, oh, crap, everything's correlated. And similarly here, wasn't it that like any one stock spiking 400% would have been fine?
Yeah.
But it was the fact that this new retail phenomenon of all of the highly shorted stocks by hedge funds melting up together was maybe the thing that
Exactly. Like, people say GameStop, but GameStop is just like, that's a name that people use because it was the most prominent name.
But like, what was the experience like? So it's week one, it's up 100%.
The week was like, the experience was like, I was almost like in shock. We were losing an amount of money that was almost hard to like even fathom that you could lose that much money in a short period of time. And imagine like we were going from being like on top of the world to within 3 weeks we were like, people were saying like, oh, these funds are going to go out of business. And I am generally pretty even keeled when it comes to markets. I've been doing this a long time. I've seen a lot of things. That was the toughest period I've ever had, and it was really stressful to the point of like, it was almost like, I felt like I was in emotional shock. Now, I was still laser focused, and I knew, I'm on top of it. I'm acting completely rationally, but it was like very, very, very hard. And I had friends who were getting bailed out by other funds. And you felt like the whole world was against you because there's all these people getting up on social media. Yeah, it kind of was. Like it was really hard. What I'd say about this job is that there's like an asymmetry of emotion, right? Like when you're making a lot of money, it's not like I'm like tap dancing around my house, like euphoric, like my lifestyle doesn't change. I feel like, yes, I'm happy that we're succeeding, but I'm happy, but I'm not euphoric. When you go through something like that, I mean, it is like
it's not one over
so painful and stressful. And it's not because I'm losing my own money. It's more about losing other people's money. It's more about like, that what's happening is completely economically irrational, and how long can you actually stick with it?
Yeah, is that the painful thing that like if you're covering the short, you know that you're covering it at a bad time because this is not a long-term sustainable price level?
Yeah, like so we covered everything at the worst time, and I knew it was the worst time. But if it kept going on for 2 weeks, all of a sudden there's a real problem. And I wasn't going to put the firm at risk. And I told my investors that this is the worst time. Now, if I had held that short portfolio, forget like from the top, if I had just held from the end of 2020, I mean, they underperformed massively. Like, it would have been like...
You were right on the shorts.
I was right on the shorts, but like I was wrong on the risk management.
So again, there's this new phenomenon of retail melt-ups in stocks, and in particular, certain stocks seem to attract the retail crowd, and the price movement of the company stock just seems to... like I was just looking now, there's like a lot of retail interest in Opendoor. And so the price movement just kind of takes off and starts doing its own thing that's kind of different to what's been happening, how it's been valued previously. How does this new retail phenomenon change the short selling game for you?
I would say that the opportunity for short selling is better than it's ever been in my career. However,
damn it,
however, you cannot capitalize on that opportunity. Like, if we went back to 2019 and the same thing was happening, like I would, be massively short these companies. But after going through GameStop, there's a ton of opportunity, but you have to be much smaller in each individual name so that you don't subject yourself to what happened in January of 2021.
But is this a new kind of science, just like understanding what the crowd is going to do, or is that just like
there's no science behind that. It's like
you could have like the Reddit analytics and following the tweets.
You could follow Reddit tweets all day long, but where does that tell me? Like, okay, the stock went up 100%. There's a bunch of people who like the stock. Obviously, if I read the Reddit, like, they like the stock went up 100%. Like, I bet I can read. It doesn't. There's no information signal there. I know that people are buying the stock. I know that they're buying the stock for a reason that I think is kind of silly. And the most important thing to me is that like we just have to be able to write it out. So like whatever happens, risk management cannot happen after the fact. Like anything you do after the fact is not risk management. It's actually just destroying capital.
Yes.
Risk management has to happen before the fact. Meaning like you size these positions so that like when it goes up, you don't have to cover.
Right.
Anyone who says like, oh, I like risk managed the portfolio because like things were going against me, like almost if you're a bad stock picker, sure.
It's like I cut my losses.
Like, if you're any good at stock picking, like risk management after the fact is a bad idea.
Yeah.
So we now size things such that like, look, I'm not trying to figure out like what's happening on Reddit or this or that. People like, it's like people get excited about one stock is in fashion one day, then the next week they move on to another one. I can't predict that. All I can do is size the positions such that if they get excited and the stock goes crazy, we don't have to cover. We just kind of let it go and ride it through.
So is it something like previously you could have had a more concentrated short portfolio where you could have had a few shorts that you really like? Now, and you would have said, oh, it can go crazy and it can 2x if it wants and I'm still fine. Whereas now you need to have many more individual short positions where any of them can 10x or 20x and you're still able to write it out.
Correct. 10x or 20x is a little extreme. We don't have that
but
very
this
often.
Kind of stuff happens.
It does happen. Yeah. Like we don't trade like $1 stocks. But yes, that's exactly right. After GameStop, we took about a year off of short selling. And then I re-engaged in short selling.
It's like someone going through a tough breakup and saying, I'm not dating right now.
Yeah, it was like, okay, we're going to like step back. Like I didn't know there was a 500-mile hurricane that existed. I didn't know that could happen. It happened. Okay, so now we have to like figure out what kind of windows we want to put in our house, right?
Yeah.
So we took about a year off from shorting, which hurt us a lot in 2022. when we got back into it, I said, look, we're going to have to be more diverse. We're going to have to be less aggressive. And my view going in is like, logically, you should expect that your returns will be worse. And then the question is like, okay, so shorting is a really hard thing to do. So at some point, it's like, okay, if you're going to diversify so much and your returns are going to go down, like, is it even worth it? And if you asked me at the time, my LPs asked me, I'd say, like, I don't know. Like, I like shorting stocks. I think we can do it. But this new strategy, not quite sure if the juice is worth the squeeze. Yeah. As it turns out, if you look at our short alpha since that time, and since we implemented the more diverse portfolio you referenced, our short alpha has been as good or better. And I think the reason is
as your long alpha or as the prior short alpha?
As the prior short alpha, when we were more concentrated. I think the reason is that you can't be as big, but there's so many more mispriced stocks that, like, you can have 40 of them instead of having 8 of them.
Yes.
And
so what makes a good short?
Good question.
There's a lot of different kinds of shorts. So the ones we've been talking about are like stocks where usually what gets the retail crowd excited on social media. Usually it's stocks that have some story which is novel and exciting. Maybe it's a new technology. The revenue growth is really good, and you're kind of analyzing the business model and saying, like, this technology just doesn't work, or like this company is actually, the founder's horrible. That's its own thing. Yeah. And then you have shorts where shorts that we think have like real terminal value risk, where we look at the company and say, like, I actually don't think this company will be around in 15 years. And that's usually because of something secular is happening in the economy.
But there's like Kodak type stuff where like the business will go away, as opposed to Theranos type stuff, usually where it's like pure fraud.
Yeah, exactly. Like Theranos would be like its own thing. So there's like frauds, which I used to do a lot more when I was younger. It's hard to find frauds at $10 billion companies. It happens, but we're not trading.
US capital markets are pretty good for eliminating frauds from the...
like you'll find them, but they're usually in companies like that are $1 billion market caps or $2 billion market caps, which is kind of below the threshold where we play.
Because you can't get enough exposure.
Yeah. I mean, like, a fraud rarely gets to be like Enron size. Yeah. So you have the retail stocks, which are just like story stocks that have, there's really no real substance to the company. Then you have terminal value stocks, like Kodak would be a good example, where you just look and say, like, here is where I see the economy going because of some secular trend or some technological innovation, and this company's business model is going to be severely compromised over the next decade. Then you have stocks where you just think that the business from a competitive standpoint is just really disadvantaged and is going to cede market share for a very long period of time. And then I say the last and least attractive shorts are the ones where it's like, cyclically, they're just over-earning a lot, and you believe that the real earnings, if you were to look like through a cycle, are much lower than people think.
And how do you think about, so there's a company, maybe they're in a bad place in the economy, it just doesn't seem like it'll work out, but there's always this fear, that they get bought out, or that there's a sudden management change. And do you just size your books such that that's okay for you, or do you use options?
I find that, like, generally, companies that have secular risks almost never get bought. Like, I rarely do I ever see a CEO say, I want to go buy something that grows slower than I do, right? Like this doesn't happen, right? Yeah. Nobody wants to take the time to do an acquisition that's going to, invite a bunch of secular risk into their business. Maybe Ron Perlman did that back in the day, but that doesn't happen. What can happen is if you have a company, like the example I gave, where there's a company in the industry that you just believe is going to cede market share for a long period of time because of their positioning or management or strategy. And then what can happen is, like, an activist comes in, takes a big stake in the company and says, like, we're going to replace the management team. And once we do that, the new management team will pursue a different strategy and, they will no longer lose market share.
Yeah.
That is a big risk in that category,
Yeah.
right? That's kind of the only category where like,
And you
that-
don't use, and to manage that risk, you just manage your book. Do you use derivatives at all? Like
I
calls
don't
and
use, I really don't use derivatives at all. The problem with derivatives is like, look, at the end of the day, when you break down what is a derivative,
Yeah.
it's just leverage and implied volatility. Like if I want
Yeah.
leverage, I can go, get leverage from a prime broker.
Yeah.
I don't have any view on implied volatility. And the problem with derivatives is there's typically a time frame.
Yeah.
And I'm not good at time frames. I don't know when a stock is going to work, or that's very difficult. So I don't like having something that making a bet that something's going to happen in a certain period of time. So we keep it pretty simple and just trade underlying stocks. So I think that like nobody buys businesses that grow slower than them, or rarely. People usually don't buy companies that are market share donors. Like what CEOs
yeah.
like, I really want to like buy this. It's like that's like a headache, right?
Yeah.
So there's a stage of the life cycle where companies kind of become unacquirable, kind of.
Those companies, like I don't worry about them being acquired.
Yeah.
What I worry about, as I said, activist comes in, replaces management. Usually the new management team can't fix it, but sometimes they can, and that's a risk. In terms of like the companies where I said like they have no terminal value, the risk is just that they usually trade at low multiples, right? And so you're basically just DCFing the cash flows. And if the cash flows, if something happens and people receive the cash flow, is going to like last a little bit longer.
Yeah.
Because the starting valuation's low, they can go up. Cyclical shorts are just entirely different. The risk is just that like you're early, or you're just wrong about the cycle. Like there's something about the cycle which is different this time. But those are kind of the main categories of shorts.
Speaking of cyclicals, why has Rolls done so well? Like they're up 5x, 10x over the last few years? This is Rolls-Royce, the jet engine and turbine manufacturer.
Yeah. Main business is aircraft engines for wide-body jets.
They're not big in AI, IGTs.
Not as far as I know. They
do a little bit.
they have an SMR business.
Okay.
So that could eventually help.
Yeah.
Rolls is not very cyclical. The reason
Aren't
why
engine makers historically cyclical?
not as much as you would think, because most of the business is I sell you an
Aftermarket.
engine, and then I sell you an engine for
Yeah.
not much money, but I make a lot of money in aftermarket,
Okay,
which
fair.
is much more predictable.
So the airframers are cyclical, but the engine makers aren't?
Airframers are cyclical, but pretty good secular growth, and it's a duopoly.
Yeah.
Rolls-Royce was just horribly managed for a long time. Like it actually had making jet engines is incredibly difficult. I mean,
It sounds hard.
a new jet engine.
hard. You look at it, you're like, wow.
A new jet engine.
I can't do that.
idea you think might be hard.
It probably takes like 5 to 10 years to do the R&D to develop a new jet engine.
Yeah.
So Rolls-Royce actually had good technology. It was just very, very poorly managed. And they signed a bunch of contracts with airlines that were very unfavorable.
Yeah.
And they had a new CEO come in, and he operationally turned the business around in a pretty fantastic way.
You guys were long Rolls, right?
Yes.
Right? Yeah.
Yeah.
So that's a good example of like, how do you, because every management team
how do you
says,
figure that out?
Yeah, every management team says we're going to turn this thing around. And every management team has a projection that like looks good. And so how did you determine that now finally they were going to turn it around?
Okay, so let me start by saying like the U.S. and Europe are very different in this respect. I find that let's take a U.S. company that had like a turnaround, the industrial company like 3M. 3M had been a horrible stock for a very long time. Wasn't well managed. New CEO comes in, puts up 1 or 2 good quarters. Everybody, and we owned it. Everybody basically understands what's happening, and the stock kind of goes to fair value with the assumption that the margins are going to go to where they should go. Like the U.S. is pretty quick at like seeing change happening and then pricing in that change.
Yeah.
In Europe, I find once a company like Rolls had underperformed for so long, I guess that European mutual funds, they just kind of got in their head that like Rolls is something we just don't want to touch.
So the voting machine is laggier in Europe.
Laggier.
Why is the information connectivity higher than in the U.S.? Like, what's going on?
I think it's it's hard for me to explain, but I've seen it over and over again in Europe. Like it's almost like when Rolls was being turned around, it was pretty clear after the first year that like what he was doing was going to work, and it wasn't like really that difficult.
Like
to
based on earnings, based on deliveries, based on talking
like
to customers,
based on you know, you meet with the management team. They say like here's our plan. Here's what we're going to do. You know, you see things playing out. You see the income statement progressing like as the person said. You get a sense for like Tufan is the name of the CEO. You get a sense for like, okay, is this person good? The same way you would assess any kind of founder.
Is the right framework that it's U.S. and rest of world, or is Europe kind of uniquely bad at this compared to Latin America, compared to Asia?
I don't do enough in Latin America to have a strong view.
But like a Japanese turnaround,
I think Japanese turnaround would be closer to Europe than the U.S.
Okay.
But I've done a lot more in turnarounds in Europe. If Rolls-Royce was trading the U.S., I'm fairly confident that after the first few quarters and people meeting the CEO, it was very clear to me that the CEO was excellent.
And why is that functionally? Like, do hedge fund managers, or like most of them presumably are in the U.S., and they mostly like to buy American stocks, or?
I think the American markets are just much more efficient. There's just a lot more capital.
But there are no hedge funds that have very few hedge funds presumably only invest in the U.S.
surprised.
I think you'd be surprised. I mean, I think Europe is generally viewed, appropriately so, as a extremely low GDP, unexciting place
Big
to
growth.
to
So
deploy
there's an
capital.
issue.
GDP.
Yeah.
There's an issue where like presenting that to your LPs is kind of embarrassing. Is that part of the problem? Like, we took a position in a European company. I'm not sure we would want to do that.
I have no.
Obviously you don't, but I'm just trying to understand why the average hedge fund manager doesn't just like back up into roles.
But isn't it just a home country bias? Like people invest in what they know?
Yeah, I mean, I think it's. Let's see. I think it's much easier from the U.S. to invest in U.S. companies.
Yeah.
Like, you understand the accounting. It's U.S. GAAP. You don't have to stay up all night in the middle of the night to follow the stocks when they report earnings. You're assuming that like hedge funds.
If you have a big position in another time zone, do you stay up to watch earnings? Or do you wake up to watch earnings?
I actually have, like, without an alarm clock, I will wake up almost exactly between 2:55 and 3 a.m. almost every day.
Wow.
That's amazing.
Wait, let's dig into
Yeah, there's so much to unpack there.
So you wake up ahead of earnings.
No, forget earnings. Like, every day.
Oh, okay.
Like, every day. Like, just because I've been doing it for, 20 years. Like, the European market opens, depending on daily table time, opens at 3 a.m., okay? And
I just want to see what happens at the open.
I don't want to wake up. I actually don't want to wake up.
Yeah, but you're there.
But it's just like, old habits die hard.
So you wake up, check Yahoo Finance, and go back to sleep?
Yeah, like sometimes I'll send out a bunch of texts
Thoughts.
to
Thoughts from the
people who have no interest in getting a text at 3 a.m. And I'll like think of things and then
Does your team have like a special setting on their iPhones where it doesn't just like
Thoughts
chirp,
calling.
but exactly, like it
I've
does the tracks and alarm?
I've never actually asked them. I don't expect. If the company reports earnings, I expect the analyst to be awake.
Wow.
And I'm awake too. Like, you can't, like, that would be like,
Wow.
that's happened like once
So
in my
the
career.
analyst
Do you go
is
back to
sitting-
sleep then?
I try to, but like,
don't.
But like, I try to, but like, look, it's like,
So the I just want to have a split screen. So
Yeah.
you are in Miami, you're up. The analyst is in a 1-bedroom in New York City.
yeah.
Laptop in the bed, on the phone with you. It's 3:00 in the morning. The company's about to report earnings. His girlfriend doesn't understand why. She's already at the couch in the other room.
Yeah.
And then it gaps down. It's gapping down. It's red. We could see the red reflected on the analyst's face.
It's a very
that
good
laptop.
movie.
Yeah.
And then what are you telling them to do right now? Are you just saying, why is it red? It should be green.
Well, I mean, usually it's red for the right reason, and then it's just a matter of like understanding. Okay, well, is the stock overreacting, or like what actually happened? Does this actually change our view of the intrinsic value of the company or not? And that's a matter of like, the analyst is in real time. We're discussing what happened, and sometimes we're buying. Rarely we're selling, but sometimes there's a quarter where it's like your whole thesis is just wrong. Usually it's like your thesis isn't totally broken. Maybe the stock is down 5-10%, and you kind of say like, I understand why, but it doesn't really change my long term.
So it's been 30 minutes now. You did your stuff. Now it's 4 o'clock in the morning. Do you go back to sleep?
Yeah, it
Because
depends.
the analyst is not going back to sleep. I'm telling you that.
It depends. Like, I ideally go back to sleep. It depends how red it is. If it's really red, then it's hard.
then
Then it's like then there's like more like we have to like if it's like down 20%, it's not like, oh, that's interesting. The stock's down 20%.
What's for breakfast?
Yeah, let's go. I'm gonna go back to bed, catch it in the morning. You know, it's like then we're like, game on. And then we're like then it might as well be 3 in the afternoon because we're deeply trying to understand like where we were wrong or if we were wrong or
you might be right at that moment and it's time to buy maybe.
Yeah, sometimes. Yeah.
So okay, let's talk about so you wake up. So now
I want to know the
you went back to
information
bed because
diet.
it was up 2% or something. You go back to bed.
Yeah.
Now it's what, 7 a.m., 6 a.m., you wake up again. And then you reach for your phone. And what's like in your inbox? What are you reading? Because you said you're not CNBC.
At that point, like the analysts, like usually when the earnings report comes out, it's like it's stressful for the analysts because like the company reports,
You're being judged on your
company
position.
reports, and I'm like on the phone with them. I'm like,
Think.
what's happening? And they're like,
Do the math.
give me a second. I need to digest the information. I'm like, think faster. And I'm kidding, but like in real time, but not really. But like in real time, the analyst is like looking at it and telling me like his perception of what's happening. And then by the time I wake up in the morning, there's usually a thoughtful earnings review, which goes through in detail what happened. And I only go back to bed if like there's nothing that has to happen. That's like, if we're not going to have to make dramatic changes one way or another to the position, I'll go back to bed. And in the morning, I'll read, what is like the analyst has time to step back, think about it, write things up. And, then by that time, like, we have a few more hours of trading in Europe. We may do something, we may not.
Let's talk about the across all markets. There is this after hours thing, and you would know better than me, but I feel like it's gotten even crazier in recent years, where it reports the stock can occasionally act extremely erratically in like both directions. Like I think after App reported earnings last quarter, it was like down 13%, and then it opened the next day up 13%.
Yeah.
What's going on there? And like you'd think it's thin enough. Like at some point, someone should come in and make markets.
Well, like, look, I for sure this is not what we do, but there are bonds that as soon as the earnings report goes out, like they're effectively having AI read the earnings report and interpret, and then it's just trading.
But when you're staring at that, do you I presume you sometimes will wait because you kind of anticipate this thing to flop around for a while?
I mean, we transact in the aftermarket, but it depends. Like if NVIDIA reports, the aftermarket liquidity is going to be huge.
Yeah.
If a company that's $10 million reports, it's a waste of time. Like if you try to buy the stock, you're just going to send it up too much. It's like better to wait.
Dan's in the business of money management, efficiently allocating capital to companies around the world. That's the job he signed up for, and seems to be going pretty well for him so far. But what we see at Stripe is that as companies scale, every founder, every CFO, every finance team, they are becoming money managers too, and not in the way that they want or that Dan does. Managing a fleet of international bank accounts, dealing with trapped liquidity, paying global teams. It's the kind of complexity that creeps up on fast-growing businesses. At Stripe, we believe that treasury management should be fast, globally native, and programmable. And that's why we're building a new financial home for your business right inside your Stripe dashboard. You can now do things like hold balances in pounds and euros and dollars and convert between them instantly 24/7 and at low cost. If you need to pay a partner, you can send money to over 150 countries with just an email address. Explore Stripe's new money management capabilities at stripe.com/treasury.
So like another thing funds will often do is as they get big, they'll expand to other kinds of products, macro. Is that ever something you think about?
Definitely not macro. First of all, like it's tempting to think that because you're good at one thing, you're going to be good at all these different things. And I think that in and of itself was like a mistake. But, the thing about my business that I like is that if you buy a great company, you might be wrong for a little bit, but time is your friend.
Yeah.
Like you own it. Maybe it has a couple back orders, doesn't go up, blah, blah, blah. But as time goes on, the company compounds value, it grows. If I'm going to short U.S. government bonds, I might never be right. Like there's not like, it's not like, oh, like over time it has to go back to 5%. Like, so you're just basically making a bet where like on my job, I like the fact that like, it's only if you buy bad businesses, you don't have that. But if you buy great businesses, you overpay for them a little bit, you get the earnings wrong a little bit in the short term. Over time, value, compounds and time is your friend. Macro, that's not the case. It's more of like a binary bet.
So you have this story of like, it basically takes time and then the market catches up. Do you have like any particular stocks that you can share where like the markets didn't get it for a very long time and it actually took quite some time for it to catch up?
Yeah, I mean, sometimes it takes the markets like years to really get it.
What's an example?
I mean, Netflix is an example. I mean, if you really like...
And is the get it moment the multiple expansion moment?
Yes.
Okay.
The get it moment
so that's really the thing, right?
Yeah. Like the interesting thing about like when people don't get it. So if I told you like what's logical, okay? Let's say you have a company. Here's a good example. Booking.com, okay, which was called Priceline back when I owned it. It was growing 40% a year and it traded at 9 times earnings. Okay. Why did it trade 9 times earnings?
Trading 9 times when it was growing 40% a year?
Correct.
That's not meant to be an occupied
Correct.
corner of the
quadrant.
scatterbox.
Correct. I mean, you have to be, yes, it didn't make a lot of sense.
Yeah.
But like the narrative back then was like, okay, they're just like arbing Google and like this is like a flimsy business model, whatever. Now, years go by. I don't know how fast Booking is growing right off the top of my head, but I imagine it's single digits.
High teens, I think.
Is it that fast? Okay, I'd be surprised if it was still growing high teens, but it's a lot slower than it used to be, and it trades at like 3x the multiple, right? So like the multiple should be correlated with growth rate, but sometimes the market is just so skeptical about the business model that even as the business slows, the multiple goes up.
So it'd be fair to say that D1 makes...
I think Meta is trading at a higher multiple than it did for the last 10 years. And we'd have to look, like don't take that as fact, but I would say Meta's multiple has expanded over time, even though just with the law of large numbers, it's still growing incredibly fast for its size.
Yeah.
But it's growing slower than it was 10 years ago. But now, I think for Meta's whole life, there was a lot of question about like the mode and TikTok and this and that. And now it's like it's growing slower, but it has a much higher multiple.
But would it be fair to say that D1 makes most of its money on this concept of multiple expansion? Like, is that the actual trade?
Yeah, so that's what I wanted to ask about because, Ben Graham talks about the voting machine versus the weighing machine. And if I read a D1 memo, it'll all talk about company fundamentals, voting machine stuff, where, Siemens Energy is a great business and like there's going to be so many turbine orders because of AI and the wind thing is complex, but it's actually grand and whatever. But over a 1 year period, the largest part of stock moves, as Daniel is saying, will be multiple expansion, which is basically sentiment. And so aren't you actually in the sentiment?
Is it vibes? Are you kind of vibe trading?
Yeah, I mean, I like to think of myself as being a little bit more academic than vibe trading, but like, look, it's, I think that you're always going to make the most money from multiple expansion.
Yeah.
Just like, it's hard to have that differentiated view on a company's growth rate. You can have a differentiated view on like the longevity of the growth rate, or the ultimate margin profile of the company based upon some work you've done. But the multiple over the long term is a function of like the perception of the stability of the cash flows over the long term, and sometimes people are skeptical of a business model, and then over time it gets proven out that the business model doesn't deserve to have that skepticism, and then the multiple expands. And you do make most of your money on multiple expansion, and that's why I said at the beginning we talked about actually gauging what is the right multiple for a business is quite hard. And when I sell companies too early, it's almost always because we use too low of a multiple at exit.
If I'm a nonprofit that you want to help out, and I say we need to put all our money into a single stock for the next, we're not going to touch it. We're actually going to lock it up contractually for the next 10 years. What would you recommend?
I think we start like narrowing it down. Like, there's very few tech companies I would say like I feel comfortable saying, like, because I just think tech just changes too quickly. So it wouldn't be a tech company. It would have to be a company with like a moat that I just felt like would be incredibly difficult to penetrate, with the growth rate that was probably not like super high, but well above GDP for a long period of time. And you're including valuation in this equation.
Like we're just going to buy a stock for a nonprofit endowment now, and then in 10 years' time, we're going to sell it. It's an odds trading strategy, but we're in the nonprofit business, not the investment business.
I like Siemens Energy quite a bit. I think that you may get a lot of the multiple expansion in the next 2 years, and then the next 8 years
fine.
might be less exciting.
Yeah.
But
we're not even going to look at it over the 10-year period.
I like. There's a company called Clean Harbors, which I like a lot, which is they do hazardous waste, and they own the majority of the incinerators in the United States. You can't really build more incinerators because of NIMBY. And as you have more onshoring, there's going to be more hazardous waste. And they have both the incinerators and they have the network to go collect. And so it's just very, very good business. That's, and the starting multiple is pretty reasonable. And I think, I can grow earnings well into the teens for 10 years. I would tell you, like, I think that predicting things beyond 3 years is incredibly difficult. I've seen more instances in my career where, like, things change in a way you just couldn't expect. That happens all the time. So 10 years is hard.
Why do you like Siemens Energy so much?
Look, I think that, over the next 5 to 10 years, first we started with, training these AI models. And I think we're still in the early stages of that, is early innings. At some point the scaling laws will asymptote out, but I think we still have years of high energy uses to train models. And then there's going to be a really long tail of inference. And so I think that, and interestingly, like the gas turbine companies, being Siemens Energy, GE Vernova, Mitsubishi, they are not AI. They're not AI native, right? So like when they look at this, they say like, this is like every other cycle we've seen. This is, we're not going to do it again. We're not going to build capacity, and then all these crazy people who are building these data centers all of a sudden realize it was a bad investment, and we're stuck with the capacity. So I think that there's a disconnect between what people in Silicon Valley think is going to happen in the next 10 years and what gas turbine manufacturers think is going to happen. So I think that gas turbines are going to be in shortage for a very long time.
Because all of the producers are conservative by nature.
The conservative nature. And
because Siemens are literally German.
And by the way, it's not crazy. Like you look at it, you're sitting there in Germany, you're like, okay, Massa's putting in tens of billions of dollars. Every day there's an announcement, $100 million. This sounds insane. I am not getting on board with this. I tend to think that the turbine manufacturers are more wrong than, and then, look, I think that the electrical grid in the United States and globally, people have not invested in the electrical grid at all because electricity demand in the United States grew at 0% for the last 20 years. And so if you think about the next 20 years, I think electricity demand will grow at 4%. It doesn't sound like a lot, but if you compound 4% over 20 years and you haven't invested for 20 years before that, it's very material. The second thing they have a few businesses, but the main ones are important, are gas turbines and then products that upgrade electrical grids. The other thing about electrical grids is not only have they not been invested in, as you start to introduce solar farms and wind farms, and people having solar in their own house, all of a sudden you need to have a much more dynamic. It used to be you have a power plant. That power plant sends power out through power lines to houses or businesses, and that's it. Now all of a sudden you have solar, wind producing power in faraway places that then have to connect to the grid. Now the grid is handling, both consumers actually consuming energy and actually sending energy into the grid. So, the grid just wasn't set up to, one, handle the amount of energy that's going to be consumed in the United States and globally, and two, it wasn't set up for all these renewables, which are going to fragment the electrical production in all kinds of different places, and require that it's not just like one power plant setting it this way. It's going to be like pretty dynamic distribution of electricity.
How should we be thinking of, so if we take Siemens as an example, so they make the turbines.
Siemens Energy.
Siemens Energy. The turbines are in short supply, so the price goes up. The commodity producer, in this case, Siemens, does not want to produce more of the commodity because they're fear of cycles. And so in theory, the amount they can charge should go up, the shortage goes up. But then I would assume if they don't produce more and demand continues to go up, the year at which you would get your turbine should also elongate. So it goes from 27 to 28 to 29. And then you start to ask the question, are there other sources of energy we should be using? And then, you get into the whole battery thing and whatever.
The solution to long lead times is long lead times.
Yeah. And just my question is, do you ever think, as you think about what the right price for the stock is there a point at which the lead time becomes so extreme that, because at the end of the day, people don't want the turbines, they want the energy, that other forms of energy become more exciting somehow?
Yeah, I think it's two things. I think one, eventually, let's assume that Silicon Valley is correct, and that all this investment is going to be high ROI, and therefore they're going to keep doing it. Eventually, I think Siemens and Mitsubishi and GE will say, you know what, we have to build some more capacity. That will happen.
I see.
I think over a very long period of time, nuclear will be probably a more viable option for energy. That's probably the best, in terms of taking everything into account, steadiness of the electricity, environmental factors. Nuclear is much better than gas. But nuclear plants take a really long time to bring on and have all kinds of other complexities. So I think that two things will happen. I think over the very long term, there will be more nuclear. But I think that people miss that, the United States has been pretty early in building out these huge clusters. Most countries in the world that have developed economies are going to need to build out. Maybe they don't need to have the same kind of clusters that OpenAI is building in Abilene, but they're going to need to have, probably for national security reasons, their own training clusters. And at a minimum, they're going to have their own inference clusters. So I think that everyone's focused in the U.S., and the U.S. is important, but this is going to happen everywhere. AI is not constrained to the U.S. It's going to happen in Japan. It's going to happen in Korea. So I think that the tail on this, it may be like any kind of the internet. It there may be overbuild, and then but if you look over 20 years, I just think that electricity is basically intelligence, and intelligence is what everyone's investing in, and ultimately the bottleneck is going to be electricity. And so companies that enable electricity production, assuming they have some moats, are going to be good investments. And I would tell you, interestingly, going back to the Europe comment, Siemens Energy and GE Vernova are basically the same company. There's no two companies I've ever looked at that are more similar. They have almost the same dollar revenue. I think it's 45, so 50.
The products they sell are pretty equivalent.
The products they sell are pretty equivalent. Nobody would say this one's dramatically. They sell they're in the same businesses: turbines, electrical grid, and then wind energy. GE Vernova trades at 2x the enterprise value of Siemens Energy, just to give you a sense of and ultimately, there's no reason why the margin should be higher at GE Vernova. The revenue base is the same. So I think the Europeans are implicitly just a lot more skeptical of, the sustainability and longevity of this AI cycle. And, that has to narrow one way or another. I don't think you can have two companies and one trade at half the price of the other one, and there's nothing about it that's actually worse.
There's also the other open mystery, which is, I believe the onshore TSMC trades at a 20% discount to the US ADR.
Mm-hmm. What's going on there?
Oh yeah, how is that possible?
That is also extreme.
Yeah.
And it just shows you the US equity markets either have more liquidity or just a different perception of the risk inherent in buying TSMC.
Yeah.
And 20% is quite meaningful for the same company.
Yeah.
But Siemens Energy is 50% discount. Now, I understand TSMC is the same company literally, but these are pretty close.
Yeah.
Yeah. Well, okay, you raised different regions trading at different multiples, and you raised Asia, which is a great segue. Everything
Asian
in China,
multiples.
everything in China is really cheap right now. You know, ByteDance trades at a really, really low multiple. Alibaba trades at a really low multiple. Do you guys do much in China?
Yeah, what's going on there?
Is that just a value trap? What's going on there?
Yeah. We stopped investing in China about 3 years ago. So, look, everything has a price, right? I think that the reason we stopped investing there is fundamentally, I have an issue with the way their economy works. I think the government has way too much influence on how resources are allocated. And
so, sorry, you have an issue as a moral matter, or you just have an issue as a practical capitalistic
matter. They can,
Yeah.
I'm not making moral judgments on China. I personally don't think it's the best.
You're just saying you don't know how to predict how the market will perform.
Look, I think that what markets don't like is uncertainty.
Yeah.
And the problem with China is twofold. One is that the government has way too much influence on how resources are allocated. I don't think they're particularly good at making those decisions, as you saw during COVID when they shut everything down for no reason and they will arbitrarily decide which industries are important and which ones are not important. And if you make too much money, that's bad. And so like all of those factors, like, for a while we were seeing the Chinese internet companies, like they didn't want to beat earnings because if you beat earnings, your stock goes up too much. You might be flagging that like you're over earning and,
Making yourself a target.
this was, so then if you look at a company, if you know they're not going to beat earnings, what are you left with? You're left with like a distribution which is not particularly attractive.
Yeah.
And so I think that like the economy there is, it's just very, very difficult. That being said, I think the valuations are extremely cheap. And I think the Chinese people are probably the most commercial, hardworking, smart. I would, if you look all over Southeast Asia, the best companies are usually run by Chinese. Like Chinese people are incredibly industrious, incredibly smart, incredibly commercial. So I find it kind of sad that, what's happening in China is stifling innovation that probably would be better than like before this all happened. If we went back 10 years ago, I think we would probably all sit here and say like, these Chinese internet companies are actually probably technologically ahead of where we are. Mm-hmm. Like TikTok was, obviously came out of China. Like, WeChat was like really probably the most advanced form of social media globally. But, the way governments behave is incredibly impactful to companies.
So you think the tech is very cool, but just fundamentally being an equity holder there is hard?
I think tech is very cool. I just don't think it's progressing at the same rate it used to because a lot of the great entrepreneurs have left because they felt like the environment for starting companies, for, driving new innovation that was going to make a lot of money, like that wasn't something that was like looked favorably upon by the government. So the best people left. A lot of them went to Singapore. And that, to me, like, I think that's a shame because with the right government and with the right economic system, China should be, the most important economy in the world, and it should be a technological leader. And I think the geopolitical tensions would be entirely different. And I have a ton of respect for, what China did from 1970s to 2020. Like, I think it is pretty much an economic miracle. But we've seen the last 5 years is like governments matter, and it matters what your political system is, and it matters how the government intervenes, and due process matters.
There's the famous case where many of the digital education apps were banned overnight. Did that really update your view of China?
Yeah, that like investors hate uncertainty, and you want to like in the U.S. like can something bad happen to social media companies? They get to called in front of Congress, but there's due process, right? Mm-hmm. Like you know that like there is a system that you can't have. Donald Trump can't just wave his hand and get rid of Meta because he doesn't like the fact that they're allowing people to say bad things about him. And so when you have a government that can act capriciously, that has a humongous gravitational pull on valuations.
Some big picture questions related to China. So there's all these charts one could look at of the concentration of Mag 7 into the S&P 500, and you could look at the 1970s equivalent of the Nifty 50. There's the inflation, which seems to be tracking the double hump story. First of all, do you like care at all about these analogies? Like, do these analogies mean anything?
These charts with all the JPEG artifacts on them.
They're
I think-
always very convincing.
I mean, like, I think there's like, you look, history rhymes, right? And the same thing in the market. So like, there is like, it's interesting to look at what's happened historically to these companies. It's dangerous to say like, look at it and just extrapolate to the point
So
where
you
you
can
say
overcorrect
like,
on the
it's-
chart.
Yeah.
But then my question would be, what would be the sign for you actually that the bubble is close to peaking? Like, is there something, an anecdote or an actual piece of evidence you look at, you say like, okay, maybe we all believe in AI, but
So you're saying AI is a bubble?
no, I'm saying I believe in cyclicality.
Yeah,
And, like the internet worked, but it was also a bubble.
It was also a bubble, yeah.
Derek Thompson said this recently in a way that I liked, which is people associate, you saying an AI, that AI may, currently be or in future be a bubble as like some kind of negative statement. But because every major tech change, the canals, the railroads, the internet, whatever, has been accompanied by a huge speculative bubble, because kind of it has to when you think about it.
Yeah.
Yeah.
That it's
Because
actually
Americans are optimistic.
right? But it's an AI optimistic statement
Yes.
to make
That's right.
that there will be a bubble.
We are
And so I think
actually
Daniel's
celebrating how
right.
important
So
it is.
Daniel's saying he's an AGI believer,
Yeah.
and AI is clearly going to be a big thing. Therefore,
Yeah.
is it this year? Is it next year? Like, when's the bubble?
Look, if you look at like the checklist of things that, like you kind of want to like look at for like what's going to be closer to the end of the bubble. If you went back like a year ago, you'd be like, okay, like yes, there's a lot of money being spent, but these companies have massive amounts of cash flow. Microsoft kicks up a ton of cash flow. Once you start having debt-fueled investment, that's usually a bad leading indicator, because obviously like when you have a lot of debt, like there's not much room to make mistakes. You are seeing like some of these latest projects are debt financed. I think that nobody knows, like I think even if you spoke to, I know when Dario was sitting here, it's like they keep investing in training, and maybe it's pre-training, it's post-training, but like at some point the returns on that training are going to be disappointing. And then it's people will be freaked out a little bit. But usually then the next time it's like back to okay, they have, the next model's good. At some point people are going to say like, well, we're asymptoting out. Like the returns on this new investment are actually not working. That's when I think you'll see a pretty big correction.
Okay, so there's the theory that there's a correction because the returns to pre-training start asymptoting. And then there's a theory of bubbles, like if you look at the 1970s and to some extent .com, which I think was really hampered by the fact that the Fed raised rates into 99 and 2000. There's another view of bubbles, which is like there's an awesome thing happening, everyone gets overexcited, but then some random thing hits the bubble. And because things have run up so much, everyone starts panic selling all the way down, because there's all the people that bought in their cost basis of Nvidia, not to pick on anyone, is like 4 trillion. So my question is, do you think we're in that mode? And is this like a productive line, like at D1, do you guys ever think like, oh, like what could be that thing and how do we prepare for that thing? Or do you sort of think like,
I think to our detriment, we should have owned more AI stocks. There are definitely like things you go down the list of like what constitutes a bubble, and you can check some things like massive debt fueled investment, just like people were building fiber.
What else is on that checklist?
Valuations. So like and bad companies trading crazy valuations.
circular financing.
I would tell you like NVIDIA is. We can have a debate about what the earnings are going to be in a few years, but it's not expensive. Like NVIDIA trades at 20-something times multiple. That's, I think within reason, and I don't think there's anything I see in the public markets which is like bubble-like from a valuation standpoint. I think if you look back in history, 70% of the time that you have this kind of like major breakthrough technology, there is a stock market bubble. And maybe what you're seeing right now in some of those retail stocks, like where Opendoor goes from 1 to 10, maybe that is like things are starting to bubble. But we haven't seen like large cap. I don't think the large cap AI stocks are trading at crazy valuations at all. So we're not seeing that yet. So maybe we're just maybe it's 1997, 1996, and by the time that we're in the equivalent of 1999, NVIDIA will be 3 times higher, and it's possible.
Someone said to me recently as well that like for a proper kind of crisis, you also need things that people thought were safe to not turn out to be safe. Like in 2000, when the Nasdaq went down 85%, it's like, well, that's a real bummer. But we did know that we were buying these highly gassed tech stocks. Whereas it's when the debt actually turns out to not be safe.
That turns out to be equity.
Exactly. Yeah.
Yeah.
That's when you get real issues.
It's very different in 1999 though. Like there were horrible companies which had no real economic prospects, trading at crazy valuations. I'm just not seeing that in the public markets now.
Yeah.
Well, I am, just not in AI.
Yeah. Yeah. You're a huge fan of SpaceX and a big holder. Why are you so excited
What's going
about
on there?
Everyone understands Elon is an amazing inventor, an amazing entrepreneur. I think people underestimate how good of a business person he is. In that, it's
my theory. Yeah.
It's okay, yes, does he invent great things? He does, but he is ruthless about bringing down costs to a point where his business becomes, a natural monopoly because it is a low-cost provider. With SpaceX, the whole problem with space in general, doing anything in space historically, was that it was very expensive to launch anything in the space because, one, the rocket blew up, and therefore, it better be really high value if you're going to set up there, because it's if you're going to take a plane from New York to LA and every time you do it, the 747 blows up, the plane ticket's going to be really expensive. You better really want to get to LA, right? I think so. The first thing is the idea of bringing down the cost dramatically by making things reusable. Now I think he was 5 to 10 years ahead of everybody else. Now, obviously it's more reusable, and the scale of the rockets is getting so big, and each rocket will be able to flow more than 100 times. And so the cost per ton of launching things into space is going to go down by relative 5 years ago, it was going to go down by 99.9%. It's dramatic, the cost. And so once you bring down the costs that way, obviously the first order effect is you launch a bunch of LEO satellites, which give us this great Starlink. And I think that will continue in a way that probably surprises people, in that I think SpaceX will probably capture more of the global telecommunications market than people expect. You saw them buying spectrum from EchoStar. But then it's okay, so if you really step back and say well, what else should we be doing in space if the cost per ton is dramatically lower? I value the company based on the launch business, which is a near monopoly and a fantastic business, and then our expectation, what happens with Starlink, which is just a matter of P times Q subs. But when you bring the cost per ton down so dramatically, you open up markets that value. They would say you fly from LA to Sydney in 30 minutes, or we start having solar panels in space that are, people say data centers in space. I don't know what it's going to be. Certainly there will be U.S. defense deployments in space, right? For sure. And then I think there's a lot of option value. I look at it and say, I think the business can triple without having to make any big bets about people traveling 30 minutes across the world or, data centers in space. But there are legitimate, a lot of medication is better manufactured in space than it is on Earth. There will be plenty of application over long term, and that's why I think it's the equivalent of Tesla's robotaxi. There is this option value out there that no, Tesla's not an EV company. It is going to own global transportation because it's a low cost provider, and it's and so I think you have that with SpaceX, and that's why I like it, because you have the downside of the cash flows from Starlink and the launch business, but you still have the option value of all the things we could dream about, which are impossible to quantify.
I totally agree on the underappreciated aspect of Elon being the business savvy, where, let's not forget, Tesla invented a new mode of selling cars direct to consumer. They had to get the laws changed in certain states because the current dealership system was enshrined. Similarly with SpaceX, for what they do, it's actually a very capital efficient business, and they've like run it in a, they've built it with profits rather than venture funding, or they've built it with customer revenues rather than venture funding, and so I think that's really underappreciated.
I think he's a better business person than he is inventor. He's amazing at both, but like people don't understand. Like he just naturally understands like just get the cost down, get the cost down, get the cost down, and that's very hard to compete against.
Do you want another?
Sure, I'll have another.
Great. You keep going there.
You know, they say Stripe is actually controlled by an Irish mafia behind the scenes. Did you actually, I mean, it's quite interesting. I didn't realize until you said it that D1 is mostly privates now, by size.
Yes, by size.
Did you expect that to happen when you started?
No, I did not. I did not expect that to happen. It's actually just more a function of how things played out than a deliberate strategy for us to grow the private business at the expense of the public business. Our public business went through some big ups and some big downs, and I think our public business, we are, and look, there is a limit to how much we can manage on the public side. We announced a few weeks ago that at the end of this year, we're going to be closing the hedge fund. We may replace redemptions, but the most important thing is like in our business, returns are negatively correlated with size, and especially on the short side.
Because you just own too much of a company to you move the stock when you try to trade it and stuff?
It's not so much on the long side, it's on the short side, because you turn things over, and it's like, if I'm $30 billion, it's really, you can't really short $5 billion companies, and most...
Could you not grow AUM and be more long exposure? Probably
what you'd want to do is, and what we may do in the future is, and what other funds have done is like, you have your hedge fund, which does long, short, and then you have a separate fund, which is like just long only. Yeah. And that can scale quite a lot because we tend to hold them longer, and you can buy very large cap companies.
So privates. So what was your first private position for D1?
That's a good question. We launched, I think our first private position at launch was, I rolled a stake. I had taken a stake starting in like 2010 in a company called Lineage, which is a cold storage warehouse company that I rolled off of my personal balance sheet into the fund. And then we made subsequent investments. And then, in the first couple of years, like we did a variety of different things. Like some, I think, worked out not as well. Jewel was like I'm not quite sure if that was, it was good and bad at times. I think it's going to be good now. And then we did ramp really early. That was good. John was nice enough to allow us to invest in Stripe in 2019.
How did you underwrite Stripe? Because again, we weren't profitable at the time, and I don't know. What does the process look like for something like that?
I actually started out my career as a financial service analyst, so I had looked at all the card networks, all the processors. It was pretty clear to me that the competitive set in merchant processing was very mediocre at best, and that their technology was not conducive to most internet companies, and nor did they have the tech stack that would allow them to adjust to what was happening in terms of e-commerce. And look, at the end of the day, is like I think that there's going to be one, maybe two companies that actually can provide the technology for companies to enable e-commerce or any online transactions. And you guys seem pretty smart. We do a lot of work on management teams, and huge market, great management team, weak competitive set is like perfect recipe for making a lot of money.
So you've got Ramp, Stripe, SpaceX, and maybe one day, of course, all these companies go public. But it would seem as if there's like a lot of later stage private companies now. Well, like, why do you think that's happening, and where do you think that's going to go in a couple of years? Like, are public markets just going to kind of be the laggards, and all the new hot stuff will be private, or will it rebalance one day?
I mean, if I ran a private company like Stripe, I wouldn't go public. I think the public markets,
it's kind of ironic because you're a public markets investor.
Yeah, I think the public markets are kind of problematic at this point. Let's just take Stripe, for example, and I won't speak for John, but basically, Stripe grows earnings, cash flow at some amount, value compounds, and then the tender offers, and the tender offers are relatively in line with the value creation. And therefore, the people who are working at the company and are creating that value get paid for that value because the stock price goes up in line with value creation. Now, what we see in public markets is you take your company public, and depending on what the retail crowd is doing that day, the stock may trade at some insane value, right? And like most people are like high-fiving. This is amazing. Our stock is like trading 2x where it should be. This is great. We're all rich. The problem with that is that
That's
like
both ways.
is like you've now pulled forward a ton of value, and so all the people working at the company now are being overpaid because they didn't actually create this value. The stock just gave this value, and then like the people who you're hiring, and those people are probably more likely to just cash out because they just made too much money.
You're robbing future employees to pay current employees.
Exactly. And then like future employees, now you have to give them stock options that or RSUs at a stock price you don't really believe in. And so the stock is so volatile that like you're actually not being paid as an employee based on value creation. You're being paid arbitrarily based upon like multiples which have nothing to do with the true intrinsic value of the company. So it's like I think it's like, obviously it's bad to be undervalued as a company because then you're issuing stock to employees at too low of a value and then they don't appreciate it usually. But it's pretty bad to be overvalued too, because employees, if the stock doesn't go up, they will definitely come back to you and ask for more options. If the stock goes up way more than it should, they're not going to come back to you and be like, oh, you know what, like, hey, I made too much money, and so you end up having this like asymmetric, I think it's really not a healthy dynamic to be a public company.
Is there anything that should be changed about the public markets to make it better? So, for example, Robinhood got rid of commissions. Is 0 the correct amount of friction for entering and exiting trades?
This is hard. I had breakfast with Vlad this morning, and I really like Vlad. I think that it's a moment in time. Like my view is that over the long term, stocks will go to intrinsic value.
Yeah.
It's taken longer than I've expected for some of these things. Like it's definitely like
Some of the shorts you were
I still believe it. I believe it. I can't tell you I have a lot of evidence that's the case, but that will happen. That doesn't necessarily help a company like Stripe if they go public and like if eventually in 5 years it's in fair value, but in the meantime they're just kind of like
whips up and down.
Yeah, whips up and down. That's bad. I'm not sure you can do anything like to change markets. Markets are inherently volatile. It just so happens that like at this moment they are more like you would think that like in the current world, if I told you that like we just have perfect information, everybody has all the information. It's like at your fingertips. Everything should be more efficient.
Yeah. Wow, stocks are going to be so correctly priced.
It should be correctly priced because everyone has access to the same information. It's actually gotten less efficient over time, for sure. And I don't know, I don't think you can just necessarily fix that.
You mentioned starting your career as a banking analyst. How has the banking industry changed?
Look, most of the banks tend to be very dominant in one geography. They're not like tech companies like Google or Meta where they're just dominant. Like JP Morgan is dominant in the US, but like in Europe doesn't matter. Like same thing with the European banks. Up until now, I think the legacy banks have more or less in most geographies been able to keep their market share. However, you increasingly are seeing banks like Nubank or Revolut that don't have the tech debt of like mainframes and old code.
And just offer better customer experiences.
Don't have branches.
Yeah.
Iterate on product faster, have better engineers. And I think that those banks are going to increasingly take market share.
Neobanks have happened in Brazil with Nubank, have happened in Europe with Revolut and Monzo and people like that. Haven't happened in the US, really. Yeah. And there's probably other geos where they haven't. How do you have a view on, will it happen in all markets? Are certain markets more impervious than others?
I think that it depends how good the incumbent bank is. Like I think JP Morgan is a very well-run bank and the big banks are well-run, but do I think that they are vulnerable to disruption? definitely.
But you still buy bank stocks, so how do you get comfortable?
Then there's like a more theoretical question of like, okay, well, if all these AI agents, basically, if before Revolut and Nubank just hired the best engineers, and so they were just like naturally going to beat JP Morgan. But if like AI agents now everybody has the best engineers because best engineers are actually not people, they're just agents. Maybe JP Morgan can be as good as other companies. That's theoretical. It's probably not correct. In the US, I haven't seen someone come in and be that disruptive.
But is that because of market structure reasons or just we haven't seen the great founder yet?
It's a good question. I mean, look, banking is not, it's not like you have both sides. Like you need deposits, you need to provide credit, right? And you need a lot of scale. And a market like the US is much more difficult to penetrate because it's so big and the competitors have so much capital to invest. Whereas like smaller countries, like Revolut interestingly has like low single digit, mid single digit market share in every country. I think that'll keep growing, but they don't actually provide credit.
Right.
So I think we're in the early days of disruption. I think you roll forward like 20 years, there's going to be some companies that didn't exist 10 years ago, but are going to become enormously large banks. But I also think the incumbent banks are probably going to innovate enough that they're not going to, go the way of like JCPenney.
Last question. If you're a youngster interested in investing, you have views on companies, but you don't feel confident yet in how to underwrite and construct a model and things like that, what advice would you give them? Someone who's interested in this stuff, but still getting their feet wet.
I think that pretty much with, anything you want to do in life, I just believe that reading, like just incessantly, is like the way to, get ahead. And investing so differently. Like it's just like read stock pitches like over and over and over again, and then watch those stocks, see how things play out. Like the market will be your mentor. But I think you need to just like really like I learned there's a website called Value Investors Club, and like I just read everything that people pitched. And I had you want to have some like framework. I liked reading Buffett's books because he has some faults obviously, but he has a way of like distilling down the complicated into very simple ideas. And so I would read a lot of Buffett books. I would read a lot of stock pitches. Anything to get my hands on with regard to like what's happening in technology, what's happening in the economy. And like to me, it's just like the more you read, the better you are.
Obviously, the Buffett stuff is very worth reading. And there's the Cunningham book that takes all the letters and smushes them together because there's a lot of repetition.
That's my favorite book.
Exactly, yeah. So that is a classic, and a lot of people listening have probably read it. So all the Berkshire letters. What I actually read recently for the first time is if you go back and read the Buffett partnership letters. So this was, the partnership he had with which he bought Berkshire Hathaway and kind of turned it into, but this was like a fund, more of a hedge fund than kind of the C Corp that is Berkshire. What's interesting is I find it stylistically very different. This is the late 50s, early 60s. And it's before he got so polished. It's before he got so folksy and approachable and careful in what he said. And a little more of the raw ambition is on display before he sanded that off.
Yeah.
And I don't know if you've gone back and read them.
I haven't read them.
Oh, it's awesome. I'll send you. It's really good reading. But the original Buffett partnership letters are kind of, I mean, obviously it's Buffett, so it's similar in a way to the Berkshire letters, but I actually think they're better in certain ways. So.
Yeah, he is a brilliant guy, but he actually does like to portray himself in a certain light.
The Buffett partnership letters felt more authentically.
Yeah, like they shine a light on like who he truly is, and but it's been good for his business to portray himself in that light. It makes sense.
You can't argue with the results.
Yeah.
All right, Daniel, thank you guys.
All right, thank you.